Good morning, traders and investors. Roger Scott here, Senior Strategist for Wealth Press. Today is Wednesday. It's July 12th, and it's a big day. It's the day we've all been waiting for. CPI today's coming out. I've got a lot of information for you, but before we begin, make sure to like this channel, subscribe to the YouTube Wealth Press channel, subscribe to my Telegram channel. I give free pics, pictures of my pets, free market analysis, my data lists. Go to rogerscott.com/Telegram. Most importantly, I've opened up my VIP room, my premium VIP room for the summer to the public. It's happening today at noon Eastern time. Do not miss out. And again, there's a link either below or above this video, whether you're watching it on the Wealth Press Roger Scott channel or the Wealth Press YouTube channel. Make sure to find that link. If you can't find that link, send me an email, support@marketgeeks.com, and I'll hook you up. Now, what are we waiting for? Let's get into all of this. Now, as you can see here, the Nasdaq is up about 50 points. The Dow's up about 50 points. This is definitely randomness, but it's a good sign ahead of the big report that's coming out today, and that's the CPI, and I'll talk about it. Now, a lot of folks are going to be looking at the headline number, and that's expected to be 3.1. The truth of the matter is any number below 4 that's showing us that there's a progress made by the Fed raising rates obsessively for the last God knows how long, it should be a little bit lower. But the main number, and don't look month over month. Nobody cares about month over month. We care about year over year. Now, here's what the Fed is going to be looking at. This is the big daddy, and this is what the Fed will be looking at. They're looking at year over year, and they're looking at this consensus to be around 5, 4.9. The truth is, even if it's 5.1 or 5.2, as long as it's below 5.3, the Fed can say in good faith that they're raising rates, and what they're doing, their behavior is making progress, and it's causing inflation to subside. It's just happening slower than expected. They'll say it, and most importantly, here's the big problem. We could have a situation where if the number is too low, if it's like 4.7, 4.6, it could be where good news is interpreted as bad news, and what it can be interpreted is as, well, if inflation is going down so well, they're almost done. And that can cause a different type of reaction. Or if the number is really good, right, then we can argue and say, well, you know, you're doing your job, and we can now go aggressively and get this to go away. So the level of which it goes can interpret what the Fed will do in reaction to this. So again, keep your eye on this number because it's a number that the Fed will discuss, and they're going to be talking all day today from what I understand. Let's see here. CPI, I know that they're going to be speaking today. Also, we're going to have the petroleum status report and the beige book. Now, before I get into the broad market, I want to talk a little bit about petroleum because a lot of folks have been asking me about it. If you look at the chart of the energy sector, and Matt and I were talking about this yesterday. He was actually asking me about this yesterday morning. He said, do you think we're going to have a breakout in energy? Well, I looked at the chart, and the chart looks really good here. I mean, it looks really good. We're consolidating. We're making higher highs. We're breaking out here. But here's the problem. Look at momentum levels. And this is the 50-day line. Look at where we're at right now. So if we were here, maybe even here, I would say I think so. But because we're up here, I don't think there's going to be that much more to go. There's not much firepower here. And look at this. Look at energy. 100% above 20-day and 96 and then 83%. So you got to be really careful here. And again, we may go a little higher, but I think we're going to have some. I mean, look at these momentum levels. This is the 20-day line. This is 5 years. You see where we're at right now? So again, I think we may come up in energies, but I think we're going to be consolidating, bringing momentum levels back down, consolidating for a little bit, and then going up. I don't think we're ready to go prime time. But if the news is really good, and if there's definitely a short supply of crude, then we may rally above that. But I'm telling you right now, technically, I would be very cautious. Second, in light of the fact that we're having this announcement today, if the news is as expected, not too bad, not too good, just that the fact that the core CPI is moving in the right direction, it would cause investors to believe that the Fed is on the right path. And we already have the fact that there's going to be a 0.25 basis point rate hike. It's what, 95%, 96% priced in. Let's see here. I could tell you right now. We're going to talk about it in a minute anyway. But here, 92%. So the 92% is priced in, and we're bottoming here. And if you look here, you'll see that we've bottomed around this level a few times. So I think we're going to get a reprieve. It's going to be a status quo that we are going to raise rates 1/4 basis point, and we're going to rally. Also, if the data is really, really negative, right? If the data is really negative, then the Fed could say, oh, we're going to start pausing, and that would cause the bond market to rally as well, because that would decrease the odds, the 92% odds or whatever they are right now. They fluctuate in real time, that the Fed is going to take action. So again, it could be a situation where if the news is in line with expectations, the bond market should rally, or at least stay near this level. If the news is bad, the bond market should stay with this level. If the news is super, super good, well, then it gives the license for the Fed to keep raising rates. Kind of like employment data. If the employment data is really, really good, right, then the Fed can keep pressing that lever. So it's one of those situations where okay data is good for us. Really, really bad data could benefit the bond market, but really good data can really hurt us right now. So keep your eye today on the bond market and the energy market, especially after the CPI report comes out, and that's coming out at 8:30, about 37 minutes from now. And I'm going to try to get this video for you before then, or at least before the morning bell rings. Now, let's talk a little bit about all of this, put all this together, and put a bow tie on it. And I also want to tell you what stocks are hitting hard right now, where hedge funds and algos are focused right now, but I'm not there yet. So investors are waiting for U.S. inflation report will have a heavy influence on market expectations and the Fed's future monetary policy. I think the numbers are going to come out okay, and I don't think it's going to cause a big to-do about nothing. I think that the fact that we're going to be having more rate hikes is baked into the market, with a 92.4% that the Fed is going to take action later this month. I thought it was next month, but it is later this month. Core CPI is what we're looking at, and as I showed you already, here is the expectations. I think we're going to be kind of in line, right around 5, maybe 5.1, maybe 4.9, maybe even 5.2. But as long as the number is below this, the Fed can say, hey, what we're doing is working. It's just taking a little longer, but everything is copacetic. But here's the interesting part. According to a survey, 65% of responders anticipated the core CPI, which excludes volatile food and energy prices, will be lower than the consensus forecast. So we'll see how that goes. I mean, it'll be interesting if that's the case, because if the number is really, really good, then the Fed can say, hey, what we're doing is working. Since we need to raise rates, let's just go for it a little more this year. The market can handle it. The economy can handle it. You see what I mean? Kind of like just like unemployment numbers, where it's really good, it can be bad, or it's really bad, it could be good, because we're in an inflationary environment. We also have the peanut gallery talking today, Kashkari, Mester, Bostic. Most of them are very clearly saying inflation is sticky and we're going to take further action. We don't know what to do. We have to wait. That's pretty much what they're saying right now. Powell is going on his tangents, but they're pretty much saying, it's working. It's working slower than we expected. We're going to keep moving full blast. That's it. That's the projection right now. Europe, they had strength in tech and insurance stocks, kind of a weird combination, but hey, I'll take it. China closed lower as investors are waiting for the U.S. CPI report and for robust stimulus to revive the ailing economy. The fact that China is doing bad is hurting U.S. And if it's not hurting U.S. noticeably right now, we are going to feel it. A, we have a lot of Chinese stocks on the report on our exchanges. Number two, like Alibaba, Tencent, Meituan, blah 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 blah, Baidu. But more importantly, China is the second biggest economy, and they're the biggest exporter. So again, we could have supply chain issues. It doesn't take COVID. It can be China. China can be off, and it can cause major problems. And we're having tension right now with chips. We got to keep an eye on China, but I'm not bullish on China right now. Nikkei hit a 1-month low. They've been really going sharply higher for a while now. Government data showed on Wednesday that the country's core machinery orders unexpectedly declined. I'm not that concerned because Japan is now focused on their own economy, not on exports. That's the big difference between this head of the country, their president, versus versus the prime minister versus the previous one. He's much more focused on the current economy, and I think he's going to be raising rates, which is one of the reasons why Warren Buffett is jumping with both feet into Japan right now, because he wants to get in before his margin rates go up, because he's borrowing a lot of the money. He's not paying cash. So just something to keep in mind right now. In terms of pre-market, Carvana rose. They had an upgrade. Let's keep an eye on Carvana. No major earnings. Earnings are coming out later this week. Now, the stock market, the Dow, looks very bullish here. And unless the CPI is really off, I think we're going to hit these resistance levels. I think that energy is going to maybe come up a little bit, depending on the report, and then fizzle out. I don't think this is going to be sustainable unless the data is really, really solid. Now, in terms of sectors that I'm liking right now, I'm starting to like consumer staples. I think consumer staples are bottoming out. I also like real estate right now. I would be very, very cautious with basic materials and industrial stocks because of momentum levels. I think utilities are at a good level. Basically, I'm starting to like all the stocks that were out of vogue. Now, if energy does rally, I think that may take a little bite out of the tech stocks, because market cap moved away from energies into technology, and then now it looks like they're appearing to move back into the energy sector. But I want to see how energy reacts to news, because lately it's been reacting negatively to news. In terms of the top stocks right now that you need to keep your eye on, I like the cruise ships. I do like the cruise ships right now. I would be very cautious with chip stocks and technology stocks, especially if they're related to chip stocks. Be careful. There's a lot of money coming in, but it could turn around. And if it does turn around, it could be near the swing high, which won't give you an opportunity to get out at a good price. I like the airlines right now. Again, I like the cruise ships. I like the airlines. I like... I like the real estate stocks, the home builders. So top stocks, airline stocks, cruise ship stocks, home builder stocks, and I still like GE and industrial stocks as long as the momentum keeps going. Also start looking at car dealerships like CarMax, Carvana. Carvana got upgraded. Keep your eye on that. Also, I like FedEx in light of the problems with UPS right now. So again, keep your eye on that. Also, Live Nation's good. Going out stocks that people enjoy traveling, going on holidays, discretionary stocks. That's where I would focus right now, but not exactly consumer, more like experience, like airlines, cruise ships, fun things. Live Nation, which sells concert tickets, and traveling, cars, people buying cars right now. So think about the things that really dumped during COVID. Those things are starting to come up right now. Now, we had an interesting 13 minutes here. I covered a lot, but I'm not done yet. Well, the market has been essentially flat for the last month for the most part. My newest seasonality trades have been crushing it. 57% plus on HON in 3 days, 28% plus on UAL in 5 days, 21% plus on SO in 4 days, 55% in eBay in 7 days, 23% in GPN in 17 days. How about 142% on T-Mobile in 3 days? These are real trades. And we've had an 86% win rate. Yes, average return 17% per trade, winners and losers, over a 5-day period since January. Yes, that good. In this crazy Michiganer market we're in. Now, to celebrate this and to answer a lot of live questions, I'm hosting a free live class today, 1 p.m. Eastern Time, and I'm going to reveal the next seasonal opportunity for free. A ticker that has shot up the second week of July every year for the last 25 years. I'm going to give it for free, no cost. Click the link below, reserve for the one-time live event. Now, if you're one of the lucky attendees at today's event, I'll even be giving out an option play on that ticker. Take this action opportunity immediately. Reserve your spot by clicking the link below. Do not miss out. 1 p.m. Eastern Time, right after my VIP room, which is free to attend. Make sure to like this channel, post comments, subscribe to our videos, subscribe to my Telegram channel, rogerscott.com/Telegram. All the info will be there as well. That's rogerscott.com/Telegram. All the info to subscribe, or visit Roger Scott's my YouTube channel, which is the Wealth Press channel. Don't go to Roger Scott channel, go to the Wealth Press channel. Anyhow, have a great day. Let's be ready for the CPI, and I'll see you guys on the other side. Stay out of trouble and be careful out there. This market can turn on a dime. Watch energy, sentiment, what they say versus reaction. That's going to be the big giveaway, and keep your eye on these momentum levels. And bond market is energy. Those are the two things you need to pay attention to today. I'll see you later. Bye.